You buy a car, you finance a college degree, you sign a mortgage on a house. Society calls these the ultimate milestones of adulthood, and your bank proudly labels them your greatest assets. The problem is how we measure their value. Most people look at capital appreciation, the hope that someone else might pay more for that item 20 years from now. They completely ignore cash flow, which is what that item is doing to your bank account today. This is financial author Robert Kiyosaki. He popularized a strict alternative framework for measuring wealth, and it relies on one brutal rule. An asset is simply something that puts money in your pocket. A liability is the exact opposite. It is anything that takes money out of your pocket. If we apply that standard, almost everything the middle class proudly owns is actually a liability wearing a very convincing disguise. To find out who is actually wealthy, we need to take a traditional personal balance sheet and draw a hard line down the middle. We are going to aggressively audit these items using only the logic of cash flow. We start the audit with the easiest target, your car. A vehicle loses retail value the moment you drive it off the lot. Beyond that, it requires constant cash for fuel, insurance, registration, and maintenance. It belongs firmly in the red column. There is exactly one exception. A car only stays in the green column if you use it commercially, like renting it out or operating a delivery business, to generate direct, measurable income that exceeds the operating costs. Next, we move to the ultimate sacred cow of the American dream, your primary residence. People defend their house as an asset because of rising value, but theoretical equity puts no dollars in your account today. To live there, you pay mortgage, taxes, and maintenance. It's a relentless cash drain, slightly offset by rent savings called implicit income. But even with that rent savings factored in, hard cash is still actively leaving your bank account every 30 days just to keep the property afloat. The very purchases we are told will build our financial foundation actually function as structural drains on our daily cash flow. As long as they drain cash, they keep us tethered to wages to pay for them. That brings us to the most abstract item on a standard balance sheet, the college degree. Higher education requires tens of thousands of dollars in upfront cash, usually financed through student loans that demand decades of strict monthly payments. A degree is only an asset if the income premium, the extra salary earned, outweighs the initial tuition cost. For many degrees, this fails. The salary bump doesn't cover the debt service, turning education into a lifelong liability. Our asset column drops to zero. So, if your house, your car, and your college degree are all liabilities, what actually survives this financial audit? A real cash flow asset is built on one of four pillars: an investment portfolio paying consistent dividends, a rental property generating net positive rent, a business operating at a profit, or intellectual property paying out royalties. Notice the pattern. A true asset is an entity that works entirely independent of your labor to push cash into your accounts. It is the only thing that actually replaces your need to trade time for money. Zoom out and look at this fully deconstructed balance sheet. Financial success is not about hoarding expensive lifestyle items just because a bank is willing to lend against them. This bar chart represents the ultimate financial metric, your portfolio ratio. It measures the tiny sliver of items you own that actually generate income against the massive block of liabilities that continuously consume it. Look at your own net worth. What percentage of the money you have deployed is actively putting cash back into your pocket today? The goal of this audit is not to convince you to stop buying cars or living in houses. The goal is to stop deluding ourselves by calling our liabilities assets. Look around your life right now. Find one thing you previously called an asset, but that actually drains your cash flow every single month. Drop it down in the comments below.